I've seen this pattern play out over and over again in my 50 years of studying markets. And I need to tell you something that most people don't want to hear. The market crash that's coming, it won't surprise me because I've watched this same movie play out multiple times in my career at Bridgewater Associates. I've studied every major market crash going back hundreds of years, and here's what keeps me up at night. The patterns that preceded the 1929 crash, the 1987 Black Monday, the 2008 financial crisis, they're all showing up again right now. And if you don't know what to look for, you're going to be caught completely off guard when it happens. Let me be very clear about something. I'm not a fortune teller. I can't tell you the exact day the market will crash. But what I can tell you, based on decades of research and managing the world's largest hedge fund through multiple crises, is that markets move in cycles. And these cycles are as predictable as the seasons. The problem is, most investors have what I call historical amnesia. They forget that what's happening today has happened before, just in a different costume. You see, most people think market crashes come out of nowhere. They wake up one morning, check their portfolio, and suddenly their retirement savings are cut in half. But that's not how it works. Market crashes are never sudden. They're the result of forces that build up over years, sometimes even decades. And if you know what these forces look like, you can see them coming from miles away. So in this video, I'm going to walk you through exactly what always happens before a market crash. I'm going to share with you the framework I've developed over my entire career, the same framework that helped Bridgewater navigate the 2008 crisis when most other funds were getting destroyed. And more importantly, I'm going to show you what these patterns look like in today's market so you can make informed decisions about protecting your wealth. Now, before we dive into the patterns themselves, I need to explain something fundamental about how I see the world. Everything in economics and markets moves in cycles. I call this the big debt cycle. And understanding this cycle is the key to understanding when crashes happen. Throughout history, economies go through the same sequence over and over again. First, there's the expansion phase where debt grows, asset prices rise, and everyone feels wealthy. Then there's the peak where debt levels become unsustainable. Then comes the contraction where debt needs to be paid down or written off and asset prices collapse. And finally, there's the bottom, which sets up the next cycle. This isn't just theory. I've documented this pattern going back hundreds of years across dozens of countries. And every single time the crash happens for the same reasons. The details change. The names of the companies and the specific assets involved are different, but the underlying forces are identical. So let me take you through the 4 patterns that always, and I mean always, show up before a major market crash. These aren't just patterns I noticed. These are the fundamental forces that drive every crash, from the tulip mania in 1637 all the way to 2008 and beyond. The first pattern is what I call the bubble psychology. This is when investors stop caring about fundamental value and start buying assets simply because they believe prices will keep going up. Now, you might think that sounds obvious. Of course, people buy when they think prices will rise. But what I'm talking about is something deeper and more dangerous. It's when the entire market becomes disconnected from reality. Let me give you a perfect example from history. In the 1630s, the Dutch went absolutely crazy over tulip bulbs. Yes, you heard that right. Tulip bulbs. At the peak of this mania, a single tulip bulb could cost as much as a luxury house in Amsterdam. We're talking about the equivalent of hundreds of thousands of dollars in today's money for a flower bulb. Now, here's what's interesting. If you talk to a Dutch merchant in 1636, they would have given you perfectly rational explanations for why tulips were worth so much. They tell you about the rarity of certain varieties, the difficulty of cultivation, the growing demand from wealthy buyers. They'd show you charts of tulip prices rising year after year. They'd introduce you to people who had made fortunes trading tulips. And if you suggested that maybe, just maybe, tulips were overvalued, they'd look at you like you were crazy. This is bubble psychology in action. When everyone around you is making money, when prices have been rising for years, when the smartest people you know are all buying the same asset, it becomes almost impossible to step back and ask the simple question, what is this actually worth? I saw the exact same thing happen in the late 1990s with internet stocks. I remember sitting in meetings where people were buying companies with no revenue, no profits, and no realistic business plan, and they were paying billions of dollars for them. When I asked how they valued these companies, the answer was always the same. It's a new paradigm. The old rules don't apply. This time is different. Let me tell you something I've learned in 50 years of doing this. It's never different. The technology changes, the assets change, but human psychology, that never changes. Greed, fear, the herd mentality. These are constants throughout history. So how do you spot bubble psychology? There are several telltale signs. First, you see valuations that can't be justified by traditional metrics. In the stock market, that might mean price to earnings ratios that are 2 or 3 times higher than historical averages. In real estate, it might mean home prices rising faster than incomes for years on end. In crypto, it might mean assets with no intrinsic value trading for thousands or even millions of dollars. Second, you hear the phrase, "this time is different," constantly. Anytime someone tells you that the old rules don't apply because of some new technology or new paradigm, you should immediately be on high alert. I've heard this phrase before. Every single bubble I've witnessed. Before the 1987 crash, people said portfolio insurance made crashes impossible. Before 2000, people said the internet changed everything about valuation. Before 2008, people said housing prices could never fall nationwide. Third, you see massive amounts of leverage entering the system. When people are so confident that prices will keep rising, that they're willing to borrow money to buy assets, that's when you know the bubble is getting dangerous. Because leverage works both ways. It magnifies your gains on the way up, but it magnifies your losses on the losses way down. And when everyone is leveraged, a small decline in prices can trigger a cascade of forced selling that turns into a crash. Fourth, you see retail investors flooding into the market. Now, I don't mean this as an insult to individual investors, but historically, when taxi drivers and hairdressers are giving stock tips, when people who have never invested before are suddenly putting their life savings into the market, that's often a sign that we're near a peak, because these late entrants are buying at the worst possible time right before the crash. The second pattern that always appears before a crash is what I call debt saturation. This is closely related to the big debt cycle I mentioned earlier. Here's how it works. In the early stages of an economic expansion, debt is productive. Companies borrow money to build factories, invest in research, hire workers. Families borrow money to buy homes and start businesses. This debt fuels economic growth. And as the economy grows, it becomes easier to service that debt. But over time, something subtle but dangerous happens. The debt starts growing faster than the income needed to service it. At first, this isn't a problem, because asset prices are rising. If you're struggling to make your mortgage payment, you can refinance or take out a home equity loan because your house is worth more. If a company's cash flow is tight, they can issue more debt because their stock price is rising. But eventually, you reach a point where debt levels are so high that all the new borrowing is just going to service the old debt. You're not borrowing to invest in productive assets anymore. You're borrowing to pay interest on previous loans. This is what I call debt saturation, and it's incredibly dangerous. Let me walk you through how this played out in 2008, because it's the perfect example. In the early 2000s, interest rates were very low. The Federal Reserve had cut rates to stimulate the economy after the dot-com crash and 9/11. These low rates made it very cheap to borrow money, and people did. They borrowed to buy houses, they borrowed to buy cars, they borrowed to finance their lifestyles. But here's the key. They weren't borrowing based on their ability to repay the loans. They were borrowing based on the assumption that asset prices, particularly house prices, would keep rising. As long as your house was going up in value, you could always refinance or sell if you got into trouble. The banks loved this because they were making enormous amounts of money originating these loans, and they didn't even keep the risk on their books. They bundled these mortgages together, sliced them up into complex securities called collateralized debt obligations, or CDOs, and sold them to investors around the world. The investors bought them because rating agencies gave these securities AAA ratings, making them look as safe as government bonds. This created a feedback loop. More lending led to higher house prices. Higher house prices encouraged more lending. And all the while, debt levels were climbing higher and higher relative to income. By 2006, household debt in the United States had reached 130% of GDP, the highest level in history. Now, I saw this happening in real time, and I knew it couldn't last. At Bridgewater, we started positioning our portfolio for a major deleveraging. We knew that at some point, either incomes had to rise dramatically to support the debt, or debt had to come down through defaults and deleveraging. And since incomes weren't rising fast enough, we knew it would be the latter. The crash started in 2007 when subprime borrowers, the people with the weakest credit, started defaulting on their mortgages. At first, everyone said it was contained, just a small problem in one corner of the mortgage market. But we knew better, because when you have a system that's saturated with debt, it doesn't take much to trigger a cascade. As those subprime borrowers defaulted, the value of all those mortgage-backed securities started falling. Banks that owned these securities had to mark them down, which hurt their capital ratios. As their capital ratios fell, they had to sell other assets to meet regulatory requirements. This pushed down the prices of those assets, which hurt other banks and investors. And on it went. By 2008, major financial institutions were collapsing. Bear Stearns failed in March. Lehman Brothers failed in September. AIG, one of the largest insurance companies in the world, had to be bailed out by the government. The entire global financial system was on the verge of collapse. This is what happens when debt saturation meets a downturn. The deleveraging process becomes self-reinforcing. Falling asset prices lead to more defaults lead to more forced selling. More forced selling leads to lower prices, and the cycle continues until massive amounts of debt have been written off or paid down. Now, here's what concerns me today. We're seeing debt levels that are even higher than they were before 2008. Global debt is over 300% of global GDP. In the United States, government debt is approaching 130% of GDP. Corporate debt is at record highs. And much of this debt was taken on when interest rates were near zero. What happens when interest rates rise? What happens when all this debt needs to be refinanced at higher rates? I'll tell you what happens. The same thing that always happens. Companies that can't afford the higher interest payments start defaulting. Governments have to cut spending or raise taxes to service their debt. Consumers pull back on spending because more of their income is going to debt service, and the economy contracts. The third pattern I watch for is what I call innovation risk. Now, this might sound counterintuitive. Innovation is good, right? new technologies, new financial products. These things drive progress and create wealth. And that's true. But innovation also creates crashes. Here's why. When something new comes along, whether it's a new technology, a new type of financial instrument, or a new market, there's a period where nobody really understands the risks. The innovation seems brilliant. It seems like it solves old problems or creates new opportunities. Early adopters make a lot of money, and this attracts more and more people who want to get in on the action. But because the innovation is new, we don't have historical data on how it behaves in different conditions. We don't know what the failure modes are. We don't understand the second and third order effects. And most dangerously, we tend to assume that because something is new and sophisticated, it must be safe. Let me give you a perfect example from 1987. In the early 1980s, a new financial product called portfolio insurance became very popular. The idea was simple. You could use computer programs to automatically sell stocks or buy put options as the market fell, limiting your downside risk. It was like having insurance on your portfolio, hence the name. By 1987, portfolio insurance was managing over $90 billion in assets. That's equivalent to hundreds of billions in today's dollars. Institutional investors loved it because it seemed to offer the best of both worlds. You could stay invested in stocks and capture the upside, but you were protected on the downside. The problem was that portfolio insurance worked great in theory and in small amounts. But when everyone had the same strategy, and when the market started falling, all the portfolio insurance programs triggered at the same time. They all tried to sell stocks simultaneously, and there weren't enough buyers. On October 19th, 1987, Black Monday, the stock market fell 22% in a single day. It's still the largest one-day percentage decline in stock market history. And portfolio insurance, the product that was supposed to protect investors, actually made the crash much worse. The automatic selling triggered by these programs overwhelmed the market and turned what might have been a moderate decline into a historic crash. I watched this happen in real time, and it taught me a crucial lesson. Just because something is new and sophisticated doesn't mean it's safe. In fact, the newest and most sophisticated products are often the most dangerous because we don't fully understand them yet. We saw the same thing in 2008 with mortgage-backed securities and CDOs. These were incredibly complex financial products that even the people creating them didn't fully understand. The models said they were safe. The rating agencies said they were safe. But the models were wrong because they were based on assumptions that didn't hold up in reality. The models assumed that housing prices wouldn't fall nationwide, that defaults in different regions weren't correlated, that the ratings agencies had done their due diligence. All of these assumptions turned out to be wrong. And when they broke, the entire edifice collapsed. Today, I see similar innovation risk in several areas. Cryptocurrency is the obvious one. We're seeing trillions of dollars flow into digital assets that have no intrinsic value, no cash flows, and no regulatory oversight. The technology is new and complex, which makes it seem sophisticated and safe, but we have no idea how these assets will behave in a real crisis. I also see innovation risk in algorithmic trading and artificial intelligence. More and more trading is being done by computer programs, not humans. These programs can react in milliseconds, much faster than any human trader. But what happens when all these programs start selling at the same time? What happens when they amplify each other's actions in ways their programmers didn't anticipate? We got a preview of this in the flash crash of 2010, when the stock market briefly fell almost 10% in minutes before recovering. But that was just a preview. The real test will come during the next major crisis. The fourth and final pattern I watch for is what I call the policy trap. This is when policymakers The Federal Reserve, the Treasury Department, Congress get caught between a rock and a hard place. They can see problems building, but any action they take to address those problems would itself trigger a crisis. Let me explain how this works. In the years leading up to a crash, policy is usually loose. Interest rates are low, regulations are relaxed, the government is running deficits. This loose policy fuels the boom. It makes borrowing cheap, it encourages risk-taking, it inflates asset prices. At some point, policymakers start to get nervous. They see debt levels rising, they see asset bubbles forming, they see risks building in the financial system. And they know they should tighten policy, they should raise interest rates, increase regulations, reduce government spending. But here's the trap. By the time they recognize the problem, the economy and financial system have become so addicted to loose policy that any tightening threatens to trigger a crash. If they raise interest rates, heavily indebted companies and consumers won't be able to service their loans. If they increase regulations, it could choke off credit and kill the expansion. If they cut government spending, it could push the economy into recession. So they're stuck. They can keep policy loose and let the imbalances grow even larger, knowing that this makes the eventual crash even worse. Or they can tighten policy and risk triggering the crash immediately. It's a lose-lose situation, and it's what I call the policy trap. We saw this play out before 2008. By 2004 and 2005, the Federal Reserve knew that housing prices were rising too fast and that mortgage lending standards had become dangerously lax. They started raising interest rates in 2004, but they didn't raise them fast enough or high enough to really cool down the housing market because they were worried about triggering a recession. So the bubble kept growing for another 2 years. And when it finally burst, the crash was much worse than it would have been if they had acted more aggressively earlier. But acting more aggressively earlier would have required them to deliberately cause a recession, and no policymaker wants to do that. Today, we're in the same trap, maybe an even worse version of it. After the 2008 crisis, the Federal Reserve cut interest rates to zero and kept them there for 7 years. They also did something unprecedented called quantitative easing, where they bought trillions of dollars of bonds to push down long-term interest rates. This emergency policy helped the economy recover, but it also created massive distortions. Companies took on enormous amounts of debt at ultra-low rates. Asset prices, stocks, bonds, real estate, everything inflated to record highs, and the entire system became dependent on near-zero interest rates and the Fed's ongoing support. When inflation finally forced the Fed to start raising rates in 2022, we immediately saw stress in the system. Several major banks failed, the commercial real estate market started cracking, and the Fed had to slow down their rate hikes because they were worried about causing a financial crisis. This is the policy trap in action. The Fed knows that rates probably need to be higher for longer to bring inflation under control and to prevent new bubbles from forming. But they also know that higher rates could trigger failures in parts of the financial system that have become dependent on cheap money. So now let me tie this all together and show you how these 4 patterns interact to create crashes. Because it's not just that these patterns appear separately, they feed off each other and create a self-reinforcing cycle that makes crashes inevitable. It starts with bubble psychology. Low interest rates and loose policy encourage people to take risks and buy assets. As prices rise, more people get excited and jump in. The bubble grows. As the bubble grows, debt saturation sets in. People borrow more and more money to buy inflated assets. The debt-to-income ratios rise. The system becomes more fragile. Then innovation risk amplifies everything. New financial products make it easier to take on leverage and make big bets. Complex derivatives and structured products hide the true level of risk in the system. Everyone thinks they're hedged and protected, but they're not. Finally, the policy trap emerges. Policymakers see the problems building, but feel powerless to stop them without triggering an immediate crisis. So they keep policy loose, hoping the bubble will deflate gradually rather than popping violently. But bubbles never deflate gradually. They always pop. And when they do, all four patterns work in reverse to create a devastating crash. The bubble psychology shifts from greed to fear. Everyone who was buying now wants to sell. The debt saturation becomes a debt crisis. All those people who borrowed money to buy assets now can't make their payments as asset prices fall and incomes decline. The innovation that seemed so brilliant on the way up becomes the mechanism that accelerates the crash on the way down. Portfolio insurance selling in '87, CDO liquidations in 2008, algorithmic trading in the next crash, and policy, which was trapped before, is now overwhelmed. The Federal Reserve cuts rates to zero, but it's not enough. The government passes massive stimulus bills, but it's not enough. Because when you have to unwind years or decades of excess in a short period of time, there's no easy fix. This is what I call the big debt cycle deleveraging. And it's the most painful economic event a society can go through. Short of war, unemployment spikes, asset prices collapse, businesses fail. The social and political consequences can last for a generation. Now, I know this all sounds pretty bleak, but here's the thing. If you understand these patterns, if you can see them building, you don't have to be a victim when the crash comes. In fact, some of the best investment opportunities of your lifetime will appear during and after crashes. So let me tell you what I do. How do I position myself and my firm when I see these patterns appearing? First, I balance my portfolio. I don't try to time the market perfectly because that's impossible, but I do adjust my exposure to risky assets as I see these patterns building. If stocks are expensive, if debt levels are high, if bubble psychology is rampant, I reduce my equity exposure. I don't go to zero because I might be early, but I don't stay fully invested either. Second, I diversify across different types of assets in different countries. This is crucial. In any crash, some assets will do better than others. In the 2008 crisis, gold and government bonds did well while stocks and real estate collapsed. In the 1970s, real assets like commodities and real estate did well while bonds were terrible. You can't predict exactly which assets will protect you in the next crisis, so you need to own a mix. Third, I keep some dry powder. This means having cash or very liquid, safe assets that you can deploy when opportunities appear. The best time to buy assets is when everyone else is panicking and selling. But you can only take advantage of this if you have money available to invest. If you're fully invested or worse, leveraged when the crash comes, you'll be one of the people forced to sell at the worst possible time. Fourth, I pay attention to fundamentals. In a bubble, fundamentals don't matter. Valuations can stay crazy for years, but eventually fundamentals always reassert themselves. Companies that generate real cash flows, that have strong balance sheets, that have competitive advantages, these companies will survive and thrive over the long term. Companies that are just riding a wave of hype and cheap money will disappear when the tide goes out. Fifth, and this is perhaps most important, I manage my psychology. I've been through enough cycles now that I don't get caught up in the euphoria of bubbles or the panic of crashes. I try to stay rational and analytical. I follow my process. I don't make emotional decisions. This is harder than it sounds. When everyone around you is making money and you're being cautious, you feel like an idiot. When markets are crashing and everyone is panicking, it takes real courage to buy. But this is what separates successful long-term investors from everyone else. The ability to be greedy when others are fearful and fearful when others are greedy, as Warren Buffett says. Now, let me address the question I know you're thinking. Are we headed for a crash right now? Is the next big one coming soon? I can't give you a definite answer because, as I said, timing crashes is impossible. But I can tell you what I see when I look at the four patterns today. On bubble psychology, I see worrying signs in several areas. Cryptocurrency went through an enormous bubble, crashed, and is now inflating again. Parts of the stock market, particularly technology stocks and anything related to artificial intelligence, are trading at valuations that are very difficult to justify based on fundamentals. And so I hear that phrase, "this time is different," constantly, usually in reference to AI. On debt saturation, the numbers are concerning. As I mentioned, global debt is over 300% of GDP. Government debt in developed countries is at levels we usually only see during major wars. Corporate debt is at record highs, and much of this debt was accumulated when rates were near zero. As rates normalize, the debt service burden becomes much heavier. On innovation risk, we have several concerning areas. Cryptocurrency and decentralized finance are obvious ones. We have new assets with no intrinsic value trading at enormous valuations with very little regulation.
We also have artificial intelligence and algorithmic trading becoming more and more prevalent in financial markets. And we're creating complex new financial products faster than regulators can understand them.
On the policy trap, we're definitely there. The Federal Reserve is stuck between needing to keep rates high to fight inflation and wanting to cut rates to support the economy and prevent financial stress. Government debt is so high that we can't really afford much higher interest rates, but we also can't keep rates at zero forever without creating new bubbles. So yes, I see all four patterns present today. Does that mean a crash is imminent? Not necessarily. These patterns can persist for years before they resolve in a crisis. The bubble in the 2000s lasted from around 2003 to 2007. The bubble in the 90s lasted even longer. But what I can tell you is this: the longer these patterns persist, the worse the eventual crash will be. And the more these patterns build on each other, the more confident I am that a major deleveraging is coming. So what should you do? That depends on your personal situation, your age, your risk tolerance, your financial goals. But here are some general principles that apply to almost everyone. First, don't panic. The worst thing you can do is make emotional decisions based on fear. If you have a long time horizon, if you're investing for retirement that's decades away, you can ride out a crash. In fact, you should welcome it as an opportunity to buy assets at lower prices. Second, make sure you're properly diversified. Don't have all your money in stocks, especially not in a handful of tech stocks. Don't have all your money in your house. Don't have all your money in one country. Spread your risk across different asset classes and different geographies. Third, be careful with debt. This is crucial. If you're heavily leveraged, a crash can wipe you out even if you're invested in good assets. Because when asset prices fall and you have debt, you might be forced to sell at the worst possible time to meet margin calls or debt payments. The people who do best in crashes are the ones who have little or no debt and can take advantage of the lower prices. Fourth, focus on quality. In good times, low-quality companies and assets can do well just riding the wave. But in crashes, quality matters enormously. Companies with strong balance sheets, real competitive advantages, and real cash flows will survive. Garbage companies will disappear. Real estate in good locations with real demand will hold value. Speculative properties in marginal areas will collapse. Fifth, think in decades, not days. The people who panic and sell during crashes almost always regret it. The people who stay calm, stick to their plan, and take advantage of the opportunities almost always do well over the long term. Markets always recover. It might take years, but they always recover. And when they do, you want to be positioned to benefit. Let me end with this thought. Market crashes are not aberrations. They're not failures of the system. They're a natural and necessary part of how capitalism works. Markets go through cycles of expansion and contraction, of boom and bust. The expansion creates the seeds of the contraction, and the contraction sets up the next expansion. Understanding this, accepting this, is the key to being a successful long-term investor. Don't fear crashes, respect them, prepare for them, and learn to profit from them. I've been studying markets and economic cycles for over 50 years now. I've seen crashes, I've profited from crashes, and I've helped thousands of investors navigate through crashes. And the single most important lesson I can share is this: the patterns always repeat. The details change, the names change, but human nature doesn't change. Greed and fear, boom and bust, bubble and crash. These cycles are as old as markets themselves. So watch for the four patterns: bubble psychology, debt saturation, innovation risk, the policy trap. When you see them building, don't ignore them. Don't tell yourself it's different this time. Adjust your portfolio, manage your risk, and prepare for the deleveraging that will eventually come. And when the crash does come, when everyone else is panicking and selling, remember that this is when generational wealth is built. This is when the best opportunities appear. Stay calm, stay disciplined, and be ready to act when others are paralyzed by fear. That's what I've learned in 50 years of doing this. That's how I think about markets and crashes. And that's what I believe will help you navigate whatever comes next in the markets. Thank you for watching.